How much can I get pre-approved for if I want to go home shopping? It's actually very complex, and it really isn't a number. It's more of a payment. Let me show you why. When we're talking about a pre-approval, we're not really approving the house at this point, and we're not even really, yeah, we're looking at credit, but it's really all about the third C, which is capacity. That's really coming in two forms. Number one, what is your debt to income ratio? How much do you make versus how much do you spend? And then secondly, do you have enough assets in the bank, cash in the bank, say your checking, your savings, retirement assets? Do you have enough to put the down payment, closing costs, and reserves on a property? There's going to be a lot of math in this, but I'll tell you what, I'm going to kind of skip over things. And if you don't like doing a lot of math and word problems in school, you can kind of skip over certain parts of this. But it's very important to understand how we determine your debt to income ratio on a consumer loan. This is not for commercial loans. This is not for real estate investors. This is how we do it for someone that's looking to buy a home for themselves, maybe a second home, or even if they're using Fannie Mae or Freddie Mac for a conventional rental product. This is how they determine it. The debt to income ratio is pretty simple. It's the debts that you have, including the loan that you're going to be getting, divided by the income, your gross monthly income. So, what debts do count? Any mortgages that you might have. Believe it or not, you also have to count in those real estate taxes. You have to count in the hazard insurance on the property, including if it is in a flood zone, we have to count that too. Any HOA expenses, condo association expenses, car expense. So if you're making a car payment, whether it's a lease or a purchase, we've got to count that. Credit cards, student loans, other installment type loans. If you borrowed money to put in solar or whatever, that's got to be counted as well. But what we don't count are your utilities, your electric bill, your phone, your water bill. We don't count that. We don't count your medical insurance. So whatever you're paying, if you're paying through your job, we don't count that. We don't count your cable or internet. We don't count childcare. So really, it's only the things that are going to show up on your credit report. That's all that we as a lender really, really care about. So what kind of debt to income ratio do you need? So when you divide out the debts divided by the assets, what does that need to look like? Well, there's two different types of debt to income that you've got to focus on. There's what's called front end, which is just the housing expense that does include your taxes, insurance, and HOA. That's called the front end debt to income ratio. So if we only consider the mortgage, principal, interest, taxes, insurance, HOA, divided by your gross income, that's that percentage. That's your front end housing percentage. What most people look closely at, though, is the back end percentage, which is all of your debt. That's going to take what we just talked about, but it's also going to include your car payments and all those other debts that we talked about outside of the mortgage as well. For a conventional loan, say a Fannie Mae, Freddie Mac type of loan, they're usually looking, the rule says 43%, but if you got stronger credit, they'll usually go up to around 50%, but the rule is say 43. FHA, usually that'll go up to about 50. I've seen it much higher than 50% for people with great credit and no debt though. VA is usually kind of the same. They're looking around that 50% or less mark. So you don't really want to take it much over that. One customer might get approved at 43, but not at 44. And another customer might come in and get approved at 50. There's a lot more factors that when they run it through Fannie Mae, Freddie Mac's automated underwriting system, the AUS, you probably have heard of DU before. It's really the automated underwriting systems. Fannie Mae's is called DO, Desktop Originator, and Freddie Mac has a different one, LP. When we run those through there, that's kind of it's supposed to take the human bias out of the underwriting process, and it will underwrite electronically a loan to tell you whether the Fannie Mae or Freddie Mac is willing to buy that loan, the debt to income ratio we load. The rule is 43% on conventional, but I usually see it go much higher for stronger customers. Let's go through and do a word problem. My apologies, but stay with me. I'll skip as much math as I can, and I'll actually do the math for you. Let's say that you're going to buy a house for $350,000. You're going to do a conventional loan with 5% down. So in other words, the loan will be $332,500. Let's just kind of keep an even interest rate. Now, obviously, depending upon when you watch this, the rates might be higher, they might be lower, but let's just say, for the sake of argument, 6.75%. So we can kind of compare apples to apples here. Mortgage insurance. Now, If you're over on a conventional loan over 80% or more, or if you're doing an FHA loan, you're going to have some kind of mortgage insurance premium, which is really supposedly an insurance policy that protects against losing money. So we've got to include that in the housing expense. Just say there's no HOA on. Let's say your car payments, student loan payments, credit card payments amount to about $1,500 a month. So we'll compare apples to apples and leave that in there. And let's say you make $120,000 a year. Now divided by 12, that's $10,000 a month. That makes the math really, really easy. We're trying to keep our math easy here. So what is the mortgage payment on this? Now, you can find calculators, free apps that you can download on your phone. You can find them online. Heck, private message me in the comments and can try to help you calculate that myself. I'm happy to do that for you. Let's say on a loan amount of $332,500, 30-year fixed rate, 6.75%. We're only looking at the principal and interest when we run this. That actually comes out to $2,156.59. How do I know that? I ran it through a financial calculator that I have. When you're figuring out just the base mortgage payment, principal and interest, that's all you're looking at. Every house is going to have different taxes. Every house is going to have different HOAs, and every house is going to have different insurances. They're going to look very heavily at those houses that are more at risk than others as far as your insurance premiums. So that will actually adjust what your payments will be. And I've got a couple of examples to share with you in just a moment. So what does the total loan look like? We've already calculated the principal and interest is $2,156.59. We add in the mortgage insurance premium, which your lender can calculate for you. You're not going to be able to calculate that. That's something the lender is going to have to do for you. Took your taxes for the year. We divide it by 12 months to come up with what the monthly amount would be. Remember, apples to apples. If we're comparing a monthly payment, everything needs to be per month, not per year. So you don't want to switch those variables around from month to year like that. Insurance, it's $250 a month. That's $3,000 a year divided by 12, 250. No HOA. So if we add all of those up, you've got a payment. It jumps from your principal and interest of $2,159 to $2,778.61. If we take a look at $10,000 a month that you're making in your income, your front end debt to income ratio would be 27.79%. And your back end would just be below that 43% mark that we talked about at 42.79. Now, if you look really close at this, that last line is very important to understand and why a lender can't just say you qualify for $350,000, because your HOA, your taxes, and your insurances are going to be so different dependent upon the property you choose. That's going to have a major impact on how much you can actually afford. So if you look at this, over 22% of your loan payment is not principal and interest at all. It goes to just taxes and insurance. Remember, there's no HOA here at all. When you ask, what do I qualify for? There's so many factors that actually go into it. And why can't a lender give me an amount up front? Well, we don't know when we're doing the pre-approval what house you're going to pick. We don't know what those taxes are. We don't know what the insurance is going to be. We don't know the HOA. The closing costs that you have to bring to the table, do you have enough in the bank to be able to do that? So there's a lot of factors that go into it. Let's look at a couple of scenarios here. Scenario 1 and scenario 2. We're going to say that it's a conventional loan, so we're going to target 43%. Remember, I do realize that a conventional loan can go much higher than 43%, but the rule and the target is about 43. So let's kind of focus on that here. Let's say in scenario 1, it's very similar to what we looked at before. No HOA, your real estate taxes are $3,000 a year, and your insurances, let's say it's well inland a little bit and it's only $1,500 a year. But under scenario 2, let's say you buy somewhere where there is an HOA. So divide it out, it's $75 a month for the HOA, let's say. And of course, that's going to vary from community to community. But for this assumption, we're going to say that the HOA is $75 a month. And let's say your real estate taxes are a little higher. For instance, in Florida, a lot of these communities have what are called Community Development District or CDD fees. They did bond issuances with usually the county or whatever taxing authority they worked with. And then to pay that off over a long period of time, the homeowners actually have something extra added to their tax bill. So if you're in a CDD community, that's why sometimes you see a CDD community have much, much higher taxes. But a little hint, a lot of times their HOAs are a little bit lower in there too. So kind of, I wouldn't say it washes, but there's a little bit of a benefit of that as well. Let's say though that your taxes are higher, you're in a community maybe with CDDs, so instead of real estate taxes of $3,000 a year, you're going to have to pay $4,500 with scenario two. Say this property has the same hazard insurance of $1,500, but let's say it's in a flood zone, it's near a creek, it's prone to flooding. FEMA says you've got to have flood insurance. So let's add another $600 for that. Let's take a very close look at scenario one. Top half, we already know. You've got $10,000 a month. We're targeting 43% debt to income ratio. That means the allowable total mortgage payment, including taxes, insurance, HOA, and the $1,500 worth of debt you've got on your credit report, that can total about $4,300 a month. That would qualify you for a $370,000 loan. Purchase price can be right at the $390 mark. So as long as you're keeping it below $390, you're going to be good on the scenario one. But let's see what happens when those taxes, insurance, and HOA really change dramatically. That's scenario two. So we're going to do the same exercise. We're going to subtract out the HOA, the taxes, the insurance, the $1,500 that you have in debt. That only leaves $2,175 left for you to go shopping. You can't just say, what do I qualify for? Lender can't tell you that because they don't know what property you're buying, what those extra expenses are going to be. So if we calculate exactly the same interest rate, the same down payment, the same other debts, the whole thing, you can only qualify for a loan of $332,000, which equates to less than a $350,000 purchase price. So if we look at scenarios 1 and 2 together, scenario 1, you were able to buy about $390,000. Scenario 2, you're only able to get $349,474. That's over a $40,000 purchase difference. So do you see how big that impact is with HOA, taxes, and insurance? Really has nothing to do with the rate. It even has nothing to do with you. A lot of this has to do with the property that you pick. So keep that in mind. Let's look at the other end of the equation. I'm not going to spend a lot of time on this, but there's also something called financial assets. And this is why your lender up front during the pre-approval process wants to see the last 2 to 3 months worth of your bank statements. Don't just send them a screen print off of your phone of the balance. They need to see all of the payments that are going in and send every page to them. Don't redact it. Send the whole thing to them. Very important that we get that when we're looking at it. We can't pre-approve a loan if you're hiding and redacting parts of those statements, or if you're just sending over screen print off of your phone of the balances that you have in the bank. That won't work. So send 2 to 3 months full bank statements. Also send full brokerage statements. So if you've got money over at Merrill Lynch or whatever, send those statements over too for that same period of time, because we can actually count that. If you have a retirement account, a 401k or an IRA, send those statements over to your lender. To me, let the lender be the determining factor as to what they need and what they don't need. Just make sure you're sending a complete amount. Let's talk about the types of accounts you want to send. Checking, brokerage statements, retirement. I got to be honest, we don't care about your baseball card collection. We don't care about household items. That's not what we're looking for. How much cash do you have that you can tap to be able to put towards a deal? One thing that we cannot count is cash that you do not have in the banking system. The law will not allow us to count that. They want to see it introduced to the banking system, not money you've got stuffed in your mattress or squirreled in a safe somewhere. Congratulations if you have it. We can't count it. There's several reasons for that, and that's because the government really watches money laundering. And if you walk in and put a big chunk into the bank, even though you got it through legitimate purposes, doesn't matter. There are certain rules on banks and lenders that we have to actually question where that money came from. It's the law. It's not the lender. It's not the bank. So we can't count that. But maybe you've got a relative. If your parents say, you know what, we're going to give you $10,000, that's fine. You can do that. Your lender can help you with what they need to see in the gift letter, because your parents or whoever the donor is going to have to write a letter with all of these different points that have to show up in it by the rules to be able to count it. But that's okay. And you want to make sure you tell your lender that right up front. Want to make sure, number one, you've got enough for that down payment. So in both of our scenario 1 and scenario 2, we were looking for a 5% down payment. That's, FHA might be 3.5, but we want to make sure, and VA might be nothing. So we want to make sure, though, that you have the actual down payment that you say in the bank, and they're going to look at that. But they're also going to look at the closing costs. Now, your lender can provide you what's called a loan estimate. As a matter of fact, when you apply, there are six factors that once they actually have those pieces of information, they have to provide within 3 days what's called a loan estimate, and that has to be accurate. They can't fudge on it. They can't bait and switch you. It is the law. They have to give you a pretty accurate loan estimate. And then also, sometimes dependent upon who the client is and when you run it through the automated underwriting, it might say, you know what, we really don't need any reserves, meaning some months, maybe 3 months, 6 months, 12 months, whatever, of the principal, interest, taxes, insurance, and HOA. In other words, the whole mortgage payment. They want to see that you're not spending your last dime at the end of the day. Now, if you come to the table and have an 800 credit score, low debt to income ratio, you haven't run up much debt, they might say, you know what, we don't need to see reserves. And that's usually through the automated underwriting system. We'll kick that out and tell the underwriter what. They might say you don't need any. They might say 3 months, 6 months, 12 months. It just depends. If you've got a much lower credit score and it's a little riskier loan, they might want to see that you're bringing more reserves to the table. Those three things are what lenders really look for when they're doing a pre-approval, in addition to the debt to income ratio. In short, I know this has been somewhat of a long and maybe confusing video, but if you are either a real estate agent, maybe you're the borrower themselves saying, how much can I go shopping for? The lender can't really tell you. They can tell you what payment you qualify for and give you some ideas, but it's really going to be heavily dependent upon other factors, including the HOA, taxes, insurance, how much money you have in the bank. There's a lot of things that a lender has to do to come up with that pre-approval. But do me a favor. Cooperate with your lender. If they ask for something, give it to them quickly, as quickly as you possibly can. And if you're giving them complete information, you've heard the saying garbage in, garbage out. Well, if you're not giving your lender enough to work with, you're going to get a really bad estimate of how much you can actually afford. Hopefully this has been very, very helpful to you. We're going to put a lot of more videos out on similar subjects, so keep watching. Thanks so much.